Moving on, plenty of ink has been spilled on why the European Central Bank is hiking rates and whether it's right or wrong. But few are asking if any of this even matters. In this next report, we explore how the relationship between interest rates and the economy has changed over the years and not always as one would expect. Take a look for more.
Last week's ECB rate hike will take years to fully feed through to Europe's economy. Data shows that since 2021, average Eurozone mortgage rates for existing homeowners have risen by less than 1 percentage point despite 0.45% of rate hikes. And while rates have since been cut, that average mortgage rate keeps on rising. Admittedly, it depends on where you look. Dutch and French homeowners have been the most insulated from hikes, while Portuguese and Finns are the least. But the big picture is simple. Around half of Eurozone mortgages are fixed for more than 10 years. And that means the rate hikes from 4 years ago are still working their way through and will be for several years to come. And that's before we even think about last week's extra 0.25% hike. One interesting consequence is that rate hikes can initially boost household incomes. Savings rates adjust quickly, whereas mortgage payments largely don't. National accounts data show net interest income for households actually rose as a share of disposable income in both the Eurozone and UK after the last hiking cycle. The only exception is a sharp contrast to when rates rose ahead of the financial crisis. But none of this means rate hikes are in some way stimulative. Still, rate hikes can have unexpected consequences. Take house building. The textbook says higher rates cool activity. Yet that isn't what happened in the US after the aggressive rate hikes 4 years ago. Demand collapsed and has stayed that way, but so did supply. Homeowners with ultra-low fixed rates stopped moving. Tighter credit standards have an impact too. Rate hikes have made consumer credit much more expensive, as U.S. delinquency data shows. Corporate borrowing tends to be more sensitive to floating rates, but 1 or 2 rate hikes here and there won't change much. And if rate hikes take years to bite, what's the point? So above all, it's about signaling. With all this fixed rate debt, what central banks say often matters more than what they do. This is Bureau Report. WION World is One.